Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Well, welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of having Mr. David Thompson with Thompson Investing. David, welcome to the show.
And thanks for having me. Appreciate it.
Sure. A little bit about David. David has done thousands of units so far. He has invested in many multifamily self-storages and mobile home parks. Last year alone, in 2018, David and his company did, I think, 13 deals, which is quite incredible. Just about 2,000 apartments. I had the pleasure of working with David, in fact, on a couple of those deals. So without further ado, welcome to Premium Cashflow Podcast, David. And why don't you maybe share with us a little bit about yourself, David, how you got started and where you're at today with Thompson Investing.
Yeah, absolutely. First of all, thanks for having me on your show. I'm looking forward to sharing some ideas with your listeners and seeing if we can help some folks along the way. But I started really in the syndication business a little over 3 years ago. I was in corporate America for about 20 years, high tech specifically, and started getting into some real estate exposure here in Austin, Texas, locally through some single family rental properties. I think a lot of people kind of start there. And then after a while, they realize, wow, after a few houses, kind of fun at first, but to try to think about scaling the business, I thought, well, I'd have to have a W-2 job for quite a long time to keep saving for those down payments. And I ran into somebody who was doing syndication, and they were pretty much a young person. I was like, well, and they're getting ready to take down like a 300-unit apartment in Dallas, Texas. And I was like, how
does that work? Right?
Yeah, how does that work? I'm sitting trying to save money for a house, and you're trying to take down a 300-unit apartment. So, introducing to me what the power of syndication, which is simply pooling investor capital and enabling investors who are busy people but like real estate to participate in commercial real estate endeavors. We focus primarily on apartments and, as you mentioned, self-storage and branched out to manufactured home parks. But let's just maybe talk about apartments because that's where most of our investors today have a lot of familiarity with. And so I started working with them, and I had left corporate America. I decided this is the holy grail of investing. I thought, wow, we have professional managers. I don't have to worry about messing around with the property. I get my weekends back. And then, I found out that, hey, they actually cash flow very well. They were cash flowing better. We're talking about cash flows and preferred returns. We don't get technical here, but, kind of 8% range. And on my homes in Austin, I was getting maybe 4 to 5%. And if I had a turnover that year, there goes the cash flow. There was not going to be cash flow. And certainly you're getting appreciation and other things around the local properties, but it just wasn't where I wanted to be. I wanted to leave my corporate job. I wanted to, have some cash flow that I could count on and some steady properties. So I asked the person that introduced me to it if I could help him. They had a couple partners and they were in Dallas, and their program was around acquiring value add apartments. Basically, apartments between 1980, 2005 that needed a facelift,
Sure.
And Sakar, it's kind of like, I would talk to investors, it's kind of like this, keeping the story very simple. Everybody has watched these flip the house shows, right?
Sure.
And that's what we're kind of doing with the apartment, but there's 300 units and there's 300 families living there. You're not going to disrupt their lifestyles by bringing drills and jackhammers into the house, in the apartment. We wait till a renter's lease expires, and then we'll go ahead and so in any given month, we're maybe 10 or 15 of these units we're fixing up, and so it takes about 2 years.
Absolutely.
That, right?
It's a bit of an extended flip or sort of
slow motion
project. you're
Yeah,
slowly trying to, chip away at it and
yeah, absolutely.
increase the valuation of the entire asset.
Yeah, right. Yeah, and so what we're, basically that's how I started. I started helping them as a team member,
Sure.
and I didn't have a lot of experience finding deals. That wasn't my interest, or deep analyzing deals and looking at spreadsheets all day. I found I liked talking to investors and educating them on these opportunities. So I became a part of the team focused more on educating and taking care of investors, raising capital, educating them on the business, and then exposing them to these great opportunities. But the investors saw right away the value of these opportunities. They felt that the way I explained it to them is, fairly low risk investments if you have operators that are in the right markets, strong jobs and population growing like Dallas, Texas, Atlanta, these kind of markets. And also, we are working with experienced operators that have, managed these types of properties before and know how to optimize them correctly, right?
And that's actually, that's a good point, David, that I get this question quite frequently that like where we are, like I'm in the Washington, Virginia area here in Maryland, just on the suburbs of Northern Virginia. So the question I get many a times is that, hey, what markets are you selecting? Or, like, for example, I'm having a meeting with someone and people would say, hey, oh, really? You invest in Dallas, or you have deals in San Antonio or Austin for that matter, or Atlanta.
Right.
And then, I kind of explain them as to, how submarkets play and, why it's so important to be in the right market. Can you maybe share with us a little bit more, David, as to how these deals work economically, demographics, job growth, and all those kind of factors that play into this environment?
Yeah, Sakar, and you touch on a couple of different things, so keep me focused and honest. I don't stray too far from answering this, but let's start with markets. And you could talk to a sophisticated investor, and they may look at 5 or 10 data points, but for the typical investor, I think everybody gets supply and demand, right?
Sure.
If I don't want to be someplace maybe in an area that's not growing very much, right? Because think about this: if I have a population growth and job growth, those are where my renters are going to have jobs to pay the rent, and I'm going to have upward pressure on supply. So in Dallas, Texas, it's a premier growth city and state of Texas. And why is that? Because of several factors. You have companies moving in from more expensive West Coast, East Coast, looking for high quality places to live, lower cost for their employees, and that kind of thing. And so if they have wage raises they have to pay, they can still get high quality people in these locations. And so they're moving a lot of their operations, sometimes headquarters, to these large areas. These cities take advantage of a great infrastructure. They have great airports, road transportation systems, that kind of thing. And the other thing that's really a fairly new trend that we're seeing a lot in those types of cities like Dallas and Atlanta are hub cities for what we call the Amazonization of things, right? So it's not just Amazon. We're talking about all these companies out there that realize that brick and mortar is very expensive. So we want to have more warehouses and last mile, get to the consumer really quickly, more efficiently, maybe not have so many stores, but we're able to deliver products to you very quickly. And that's where the transportation systems and geographically where they are. So we look for, at a very simple level, we look for job growth and population growth that's growing faster than the national average. That would be a great place to start. Number 2, I would say, is diversity of industry. Dallas and Atlanta have lots of different industries, so I'm not going to be hurt if one industry goes down through some kind of recession like oil or something like that takes a recession down. Houston many years ago was very dependent on oil, and even somewhat when 4 years ago when it fell, it got a lot of not only the direct jobs in oil, but all the indirect jobs that support the oil business. Right? So renters, right? So that's what we like. We like those strong markets. You could talk about every market, every city might have submarkets. Dallas, for instance, has 28 submarkets. We would then look for those 28 submarkets, the ones with the highest rent growth. Something's happening there. If you look at apartments, that's driving rent growth in that particular submarket. So we're looking to acquire properties, maybe in the top 10% of those submarkets have the highest rent growth. Something's happening there. More companies are moving in, not a lot of supply. And so that's a good place to start. there's one other part of your question, because you had a couple of them there I want to answer. Why is syndication so powerful for people?
Right.
And when I talk to investors, we don't, we always look for people who are interested in passive investing, but I do run into a lot of investors that like to have a little bit of active stuff going on. They may have a rental property or two that them and their spouse, they work, and that's fine, and they feel like they have some control. But that's great to me in your local area. Like, so you're in Maryland, they got a couple of those things going on, but really, I just told you about Dallas, Atlanta. There's more dynamic markets out there.
Oh, absolutely.
So
Absolutely.
you got a busy job, you got a family, you don't have a lot of time. The syndicate is totally focused on this particular market, and they've done a lot of deals in that market. They know who the players are. They get the broker relationships going. The brokers steer them to the right deals, and this whole machine's going on. I want to be part of that. These guys are experts. They're investing with you. They're going to do what's best to optimize the value. So, in a nutshell, Sakar, you get geographic diversification is significant. You can really diversify your portfolio geographically through a syndication much easier than trying to manage this on your own, right?
Absolutely, absolutely. And also, one of the things, David, I always highlight to our investors is that these high growth markets give you that appreciation. So like, for example, you could be looking at a pro forma and you may have a project plan that calls for like maybe 5 to 7 years of the whole plan for the asset, right? So as years go by, the operator is renovating the apartments, the net operating income, the NOI is increasing, and come year 3, year 5, as you like value and see the income coming in, the resultant value of the whole asset is so big that you just cannot deny that, hey, the market has appreciated and the whole asset has gone up. And that's where the beauty of this comes in, is that on one side you have cash flow, but as years go by, it's almost like, I like to call it, that you have a strong wind behind you, and that's just increasing your possibilities.
Yeah, absolutely. You said something there that jogged the memory point. I want to make sure that we get across to investors, and you could be at different levels of sophistication here, but one of the most powerful, exponentially powerful idea that when I started moving from investing in single family properties and even small multis up to about 4 units, like duplexes and fourplexes, the valuation method is based on comparison.
Right.
I have a 3x2 bedroom home. My neighbor across the street sold a very similar vintage 3x2, same square footage, looked like my house 6 months ago. The price of my house is probably going to be pretty much the same when I sell it.
Sure.
I can't go in there and put gold linings all over my house and go ahead and upgrade it to the most extreme. I'm probably not going to do well with that. I'm going to overspend and not get the price. People aren't going to pay for that, right?
Absolutely.
But in apartments, what's really cool, we had that same kind of concept, but even more powerful. So anytime you get above 5 units or more, it's based on, as you mentioned, income. So if I buy an apartment, we look for like 1980s to 2005 to do these facelifts. If I go in there and I say, okay, if I redo the carpets, interior renovations, redo the kitchens and baths, just like people would do on these flipping shows, and I do that over 2 years, I'm able to command a higher rent.
Sure.
Higher rent's going to drive a higher income, right? And I can have the same apartment across the street, and it would be differently valued because, as you mentioned, the valuation is driven by, in commercial space, how much income the property produces.
Right.
And it's exponential. We won't go into the equation right now, but it's exponential. I mean, I'll give you one example, small example. We purchased an apartment. It was my first deal in Dallas, Texas, the Carrollton Oaks. 320 units, never forget this. We purchased the home. Sometime in the 1980s, the builders decided that Texas wasn't that hot. I don't know. It must have been an off year when they built this apartment. It was cooler that summer. I don't know. But there's not one covered parking. We're there in May. It's 100 degrees already, and cars are just melting in the parking lot. And so the operator I was working with said, it would be nice to have covered parking here, and we would probably charge $25 a month.
Premium,
We could probably have that asset done and paid with the project paid for in a year and a half. But here was the interesting thing. I'll do the math for you. It was just really cool. that one little idea, the property manager did a survey, and 200 of the 320 said, we'll pay $25 a month. So we only built about 200 of them. We didn't want to build 300 and not sit there. So we built about 200 of them. So at $25 times 200, it was $5,000 extra revenue a month, right?
Yeah, absolutely.
In a year, that was $60,000. And you say, well, Dave, well, maybe did you increase the value of the property to $60,000? No.
No.
And I'm not going to go deep into this, but the equation is very simple. The concept may be a little bit new to people, but 60,000 divided by the cap rate at that time was, I want to say it was like a 6 or something, right? So if you divide the 6%, if you divide $60,000 by 6%, it equals $1 million in fair market value. We've added to the property $1 million in fair market value
just by that little change.
Thing. So if you're owning these investments with us, you're like, wow, Dave, how do I be part of that? That's exponential. You know, and the other thing is creating the value. That's what I love about it.
Right,
it's not a buy and hold strategy. It's not buy the asset, do nothing to it, just to operate it simply. Because, you know, look where we are in the market. It's 2019, right?
Sure.
2012, you could have thrown a dart at any apartment and made a ton of money because the rising tides lifted all boats. Doesn't matter if you're good or not.
Sure.
You've just been fortunate. Now you have to be savvy, and now you have to look for specific properties you can do that to. But you can still create value, but not a buy and hold. It's kind of risky, right? Buy and hold's like, hey, we could have a recession in 6 months, a year, 2 years, and I bought it at the top. But if we buy a property we can add value to, we're creating our own value, so the ball's in our court. And I think as an owner and a partner in these deals, that's what I get most excited to share with investors is that we don't have to really rely totally on the economy driving our price up of real estate like we do with our single family home.
Sure.
We want a good market, yes, but we don't have to have a great market to create value. Does that make sense?
Absolutely. Absolutely. And also, David, speaking of, a lot of time investors are saying, hey, what my returns is going to be. They're not familiar with the concept of preferred returns.
Sure.
So if you could, maybe elaborate how we, sort of insulate the investors and make sure that investor interests are always in front and the operators align their interests so that the investors that are partnering with them are always profitable. So could you maybe talk about the general partnership, limited partnership structure and how the returns work in these deals?
Yeah, I'll do that. Let's start with your first maybe question was kind of expected returns. And
sure.
You guys got to be careful about, because these are forecasts, they're expected. It's what we're seeing right now in 2019. But
sure.
If you're listening to this in 2022, the expectations may be different. But
oh, absolutely.
for right now, we're seeing in the marketplace, most of our multifamily deals are penciling out to the 7-8% type yield, cash on cash yield. So if you invest, let's just make it simple, $100,000, the investors should be looking to get around a 7,000 or 8,000 in their pocket, right?
Sure.
Not guaranteed. It's kind of our target or our pro forma, what we expect to pencil out to. We also expect that $100,000 investment to grow over a 5-year, maybe a 7-year period, a double. A double to us, we call a multiple 2x. We'd like to see the 100,000 grow to 200,000, and part of that's going to be distributions I'm going to send to you monthly or quarterly from the operations. We're going to have success in the operations as we renovate these properties, charge higher rents. We're going to be able to throw more cash out to the investor. But we typically just say, hey, for 5 years, we're conservative. For about a 5-year hold, we're going to try to target this 8% to you every year for 5 years.
Right.
So about $40,000 of your 100,000 is going to come from what's called a preferred return or this cash flow, right? About 60% where pro forma is based on a sale in 5 years. So it's think about this kind of total return concept. We're actually lowering your risk because it's not like a stock. You don't put $100,000 here and hope in 5 years you get a double. We're saying, listen, it's a hard asset. It's already producing cash. We're trying to make it produce more efficient cash, higher level cash.
Sure.
And so we have a general idea that we can hit these numbers, but at least half of your money is going to be 40% of your money is coming back from just regular operations. And that's what people love. That's the passive cash flow that we're providing, right? Now you asked me about the structure, and I mentioned a term called preferred return. I work with about 3 multifamily providers in different niches. It's typically across different niches. I see this formula, an 8% preferred return. After that, a 70-30 split. the limited partner, general partner. What does that mean? So, Carr, you're an investor. You're investing in our general partnership. I say to you, listen, the expectation is you give us $100,000, we're going to target an 8% preferred return, which means any dollar that we come out with from operations or even a sale down the road or even a refinance, anything that happens where we're distributing cash to you, the first 8%, 100% of the first 8% is going to go to you, the investor, limited partner, before the general partner gets paid, okay? After that, once we go above 8%, then a typical split I see is 70% to the limited partner. For every dollar over that, 30% to the general partner. That's the most simplest formula. You've got more complicated strategies. And then we can talk quickly about the general partnership, how they get compensated, if you like, just real quickly.
Sure. Why don't we go in there?
Because people need to understand that general partner is not going to wait 5 years in a sale to get their 30% piece. There are a couple general fees. Now, that's all baked in. So when we show you these pro formas and what the investor could see, those fees are taken into account. So what we're showing you is net fees, right? But two things, when you look at these, we call it a private placement, not to get too detailed, but if you like an investment, you see the overview of it, you explain to you well, and you want to get into it. Eventually, you're going to have to look at this 100-page legal document called a PPM, we call it in the industry. This will all be spelled out, the partnership agreement, how it all works, the risks in the project, these types of things, the offering and all that, and a subscription agreement you sign. But essentially, this PPM you end up signing is important for you to kind of get into the deal. But we outline all this structure. In the PPM, we outline the fees. We outline the fact that there's probably two main fees I see mostly, and the industry standard is probably around 2% on both of them. There's a 2% acquisition fee, and that's paid at closing one time based on the purchase price of the asset, and that goes to the general partner, the sponsor, and it really much, I say it pays the folks that work on the team to get the deal done, right? The people who review 50 properties to find that one, the operational team that's getting ready to take over that group and also, or that project, and also the capital raise folks that help bring the investors to the deal. That's one time done. Then there's one other fee we see a lot. It's called asset management fee. It's typically around 2% as well. 1 to 3% is the range. Basically, the operator is going to want to get paid for doing all of this work, executing the business plan on the property. So that's called asset management fee. It's usually taken off, quarterly off of the revenue generated. But I always like to tell investors, listen, you want the general partner healthy, but if you look at how it's structured, 70–80% of their profit or their income in this whole program or their payout in this whole program is tied to a capital event down the road, a successful operation of the property, a successful sale and exit. So it's important for when investors are looking at deals, they want to make sure it's not structured so where the GP gets paid up front and then the investor, hey, whatever it gets in the back. So I like to look for preferred returns. Not all deals have them, but it's not a guarantee, but it kind of gives you the sense that, hey, you're going to get most of this stuff as an investor.
Right. And also, David, speaking about, sort of conservative underwriting and also the sensitivity analysis that comes along with these deals, can you maybe share like how conservatively underwritten these deals are? And upfront, when they do the sensitivity analysis, which is basically in short saying that, hey, these are the various scenarios that we are mimicking so that, hey, if the interest rate goes up or if the occupancy of the place, dips a little bit or any other event happens, how all that is modeled in ahead of time. Can you maybe share a few words about, how all that plays into this?
That's really important. I think that's why when you're working with experienced operators, you want to be working with, on my side of the equation, I want to be working with experienced operator partners that are conservative in underwriting. What conservative, some examples of that would be, if in that submarket we're talking about in Dallas, if the experts, the third-party experts out there, the real estate data firms that give you all these forecasts, they actually will say that specific submarket is expected to grow over the next 2-3 years at 5%. Okay. Now, when we model out, we don't want to model out to 5% or 6% or 7%. That would be too aggressive.
Correct.
Conservative would be maybe modeling out to 3 or 4%, maybe 3% year one, maybe 4%. We always want to be modeling out lower than the expectation.
Correct.
Another great example would be when we do the modeling to determine what kind of new rent growth we can get if we renovate these apartments, right?
Sure.
How do we determine if we're going to, if we want to raise those rents, we see, hey, our pro forma says we need to raise them $150. Well, that's fine and dandy, but if everybody else around you has done that and they're only getting 125, we don't want to put 150. That doesn't make any sense.
Correct.
So typically we'll go out there and we'll look at the competitors that we think, hey, if we did this and this, we have a like kind property only, 1 mile down the road that's done it, already fully renovated, and they're getting $200 more. Okay, why don't we pro forma out to 150?
Sure.
That's what you want to be looking for. You want to look for these key drivers, primarily around the rents you're going to charge, occupancy, especially in the first year. Keep in mind, it sounds kind of easy. Hey, we're going to go in there and renovate and just magically get all these rents. Well, there's a lot of hard work involved. I have to tell you,
no question
he's getting paid for a reason.
Yeah.
Oftentimes, when you're going into these properties, you don't know what the previous owner and that property management team was allowing. They probably had residents in there, tenants in there that may have missed a couple payments, but they don't want to lose them. They want to keep occupancy high before they sell it. So you've got all this drag happening when you take over a property. You certainly audit stuff, but there's a lot of ways to hide things, right? So you take over a property and you realize, hey, there's 10 or 15% of the population here I have to evict potentially.
Sure.
Or, we come in with you have to shore up their finances. So we can see, and we always see, a dip in occupancy. So the good news for investors is we typically buy properties that are proven, low to mid 90% occupancy. This isn't an occupancy play. We're not trying to create jobs and drive up demand. It's already there. The properties that we're buying are already proven properties. That lowers your risk, right?
Correct.
But we always want to pre-wire investors to say, hey, when we start sending you monthly reports and quarterly reports, especially maybe that first 6 months or so, be okay with the fact that our occupancy may drop to mid 80s. Okay, be okay with that. Don't freak out. It's going to come back. If we're going to basically reposition. That's reposition the property. We're going to rebrand it. All these things that we're doing. So that's really important to us. We want to make sure that people understand that our pro forma should show in year one. Maybe we're going to show 90% on average instead of 95. We're going to be on average. We go 85 to 95, maybe over that year, or 92. But on average, we're going to show less than what the T12 or what the previous owner said it was going to be, or the market says it was going to be. We're going to show in that first year or two maybe a little bit lower occupancy. That's a conservative thing you want to be looking for. Does that make sense? So occupancy, rent rates, those things would be conservative. I think that was your first question. Can you remind me of your second question?
Right.
More around.
The other was around sensitivity analysis.
Yes, perfect. So that plays right into the deals that we have. You want to work with an operator who shows you what's called, as Sakar mentioned, sensitivity analysis.
Correct.
Sounds kind of scary. Sounds kind of woo. Hey, any person who's even a layman can be taught what this means. Okay, we're going to show you the projected rents and intersection of projected rents and occupancy when it's stabilized in this project, and we're going to say, oh, that's why you get 8%. That's how you get 8%.
Sure.
But if we have a recession, a severe recession like we did maybe in 2009, we want to stress test this thing and say, listen, if rents were 10% off what we projected, that's a big jump down, right?
Sure.
And if occupancy went down to I think most of the time we can go all the way down to 81% on our charts, we're still making 2 or 3%. We're still able to pay our mortgage, which is the key. And we know that in 2009, Dallas, Texas, the worst occupancy got was 85%. So we want to know in the markets, we want to get data and go back to the worst case scenario, which 2009 was pretty bad, right? We changed a lot of, and we want to say, how would this apartment hold up? And so that's one part. The other one, we do interest rates. We do interest rate sensitivity if we have a variable rate loan, and we do sensitivity around the cap rate, which is part of that equation, NOI over cap rate, fair market value. The cap rate can change, and we want to make sure that we're conservative with that cap rate. So if we bought an apartment at 5 cap, we want to make sure we're at least at 5.5, maybe 6% on the exit cap, so that if the cap rate grows, we're going to negatively affect the price. And we want to show that to our investor. What would that do to your return? So is this acceptable? If it went to 6%, hey, I'm still making a low 11% return. I know you were targeting 15, 18, but hey, I'm still beating what my money was in the bank and it was still a good opportunity, right?
Sure.
That's exactly what we're talking about. Yeah.
And also, David, if you can maybe briefly touch upon how are the tax benefits for the investors as part of this? Like, are they getting K1s and things like that?
Yeah, that's a fantastic question. The beauty of real estate, not only it's stable, it's gone the test of time with the value add properties. They do really, we didn't talk about risk, but we can maybe talk about that. They've held up really well versus a single family home from a risk standpoint. But
Sure.
As far as taxes, you get all of the things. If you have a rental property, you get to write off the property taxes, the interest on the loan, and depreciation. And with apartments, we do accelerated depreciation, typically over 7 years versus 25. So there's a lot of write-offs. So let's go back to that $100,000 investment example. $8,000 preferred return. You got $8,000 in your pocket that year. The partners need to give you a K1 statement in March of the following year for your tax preparations. It says, hey, Sakar, you made $8,000. Congratulations. But, oh, by the way, you actually had a loss. So we expect you to have a paper loss most of the years, if not every year, holding it because of all these deductions. Right. And so that's the beauty of real estate. Now, there's some recapture of that depreciation at sale, but we won't get technical here. Just know that you're not going to experience a big tax hit with that $8,000. Sure. It's a passive loss, and you can use that against your passive income in your portfolio. The second thing you want to know is, at sale, what happens? Well, it's a long-term capital gain if you sell and you pay the taxes, but with some of the operators that we've had, we've been able to do a 1031 exchange. And we take your original investment plus your profit and roll it into the next investment. Then you defer that long-term tax. And now you keep going along that way. And the last thing that we see after 2 years, if we don't sell the property right away, we've created this income. We'll often go back to the bank and said, listen, if we don't have a buyer right away, let's go ahead and refinance the property. And that pulls out that equity, kind of like a little ATM machine. It pulls out that equity so we can maybe pull out 25%, 30%. I've seen up to 40%, 50% of your 100,000. We pull it back to you and give you a check. Sakar, hey, we had one apartment in Dallas, a 40%. This investor had a $100,000 investment. We gave him a check back for $40,000. Okay, so that was the refinance equity back to you. No tax consequence. The IRS determines that as a return of original equity. Another beautiful thing.
Absolutely.
And now we're still in the investment, still paying you, your distributions until we find a buyer of that property. So from a tax perspective, that's why people love these investments too. It's very tax efficient.
Sure. And also, David, I know a lot of like accredited investors, sometimes their capital is, let's say, tied up into certain business or things like that. They are sold on the concept that, hey, this is really solid. Sometimes the timing is just not right. So I always explain them that, hey, your IRA could be a resource that is typically untapped, and all these 401ks and things like that are always tied to some mutual funds or stock market, and they are always struggling that, hey, I have this big problem where my the biggest pile of my investments are not getting the enough returns. So I explain them that, hey, there is a way you can open a self-directed IRA and, kind of control this investment, how it works, where you can invest. And you and I, we both know that this is done in a very big way. Can you maybe chat about that? Hey, how IRA investments have done and, how they can come about. Invest in such
I think it's a powerful way. We have a lot of money tied up in IRAs in this nation, and the only people that they know about is, the only thing they know about is stocks, bonds, and stuff. So what you want to do is you can take part of your traditional IRA or, however much you want to allocate to real estate or some other opportunities, and open up a self-directed IRA. And there's companies out there that just specialize in that. We won't go into a lot of detail, but they're out there. They're nationwide. They're reputable.
Absolutely.
And so you can move that. It probably takes a week or week to 2 weeks to move it, but then you're in control of the investments at that point. You're still working with a custodian. But in that scenario, what's nice about that, it now opens up to a lot more different choices. Your traditional IRA, you can pretty much only do stocks, bonds, and those kind of things. So here now you can invest in real estate, you can invest in businesses, you can invest in a lot of different things. So people need to realize that that's an avenue open to them. And so yes, you can invest in our real estate. We see it done all the time. One thing I do want to caveat though that you need to be aware of, I'm not a tax expert, but I'm aware of this because my CPA told me about it, is when you buy, if you bought all cash, this is real estate, this is not a problem. But if you buy leveraged real estate, you are subject to what's called unrealized business income tax. It's called a UBIT tax. So
UBT,
just have that discussion with your tax advisor about what that might impact you on these types of investments. It's essentially, basically, the IRS doesn't want you to take advantage of the leveraged portion of the asset and the profit that generates. And so there's some tax you have to pay on that. But I've looked at this from a standpoint of the types of investments that we offer, and oftentimes it still makes sense to go ahead and use your IRA, right? Sure. You still want to diversify your portfolio, still the types of returns that we're showing people, even with the tax, it still may make sense to you. So I don't discourage people just because of the tax. Just do your analysis and homework and understand it. But it's a huge opportunity for people. And I know the solo one 401k, if you have your own business, a solo one 401k, you're not subject to that UBIT tax. You have usually can put more money in a solo 401k. So if you're an entrepreneur out there, to go explore a solo one 401k and the opportunity that you can buy real estate with those, because those UBIT taxes aren't impacting in those types of scenarios.
Gotcha. Thank you for that explanation, David.
Yeah.
And I know, David, your company, Thompson invests into self-storage facilities and also mobile home parks. And that's another asset class where I think that kind of, I like to say that it always kind of flies under the radar. Like, for example, someone rents a self-storage facility. I mean, you're paying 60, 70, 80 bucks. And I mean, nobody cares. But, hey, 6 months go by, that $80 would have been like 98 or 100. So in short, what I'm saying is that such are the sound investments within self-storage or mobile home parks that a little bit of increase in their income has a big impact to that asset class.
Right.
And it kind of goes undetected how powerful these other asset classes are. Can you maybe share, I know you have a wealth of knowledge having done into this. Can you maybe talk about, like, a similar goes for mobile home parks as well. So can you maybe share your experiences around these and how powerful these are?
Yeah, I mean, each of them have their own kind of nuances, but at a high level, both self-storage and manufactured home parks are highly fragmented markets, meaning that they're 80% in the hands of mom and pops. That I'm sure some run them very efficiently and some don't. And I think that's the opportunity to find those ones that aren't run very efficiently. Mm-hmm. They may not have the budget to keep up, renovate, keep up with the latest technologies, the climate controlled, all that kind of stuff. Mm-hmm. These are legacy type storage units, or manufactured home parks the same way. They may have lost, people have moved out of them. There's empty pads and those types of things. So we like the fact there's overall in these industries, those two industries, we like, why do we like both of them? In self-storage, people have a hard time throwing stuff away. We're in the United States, I don't know if it's right, the rest of the world is like this. We love to buy things, we're well marketed to, and we have a hard time throwing things away.
Getting rid of
it. So the average person, 1 out of 10 people in the United States is renting a self-storage facility and paying, probably 80, 100 bucks a month, and they forget about it. And 3 years later, they say, that was kind of stupid. Maybe I probably, want to get out of that. But meanwhile, the owner is going, this is great. I hope you forget forever. And first of all, they're also both self-storage and manufactured home has the same thing. They're very low cost to operate. Apartments probably operate at about a 50% expense ratio. These are probably operating at 30, 35% expense ratio. Wow. And those are ones that aren't even managed maybe so efficiently. The ones that are really managed efficiently even get lower than that. But so there's, I mean, think about this. If you are renting a self-storage unit, basically once you clean out your stuff, what I have to do for the next renter is basically sweep it out and give you and do a lock, right? With an apartment, absolutely. I got to repaint it. I got to do a lot more expensive than a makeover, turnover. Plus my leases are maybe month to month. So I can raise rents quicker. I've seen some operators, they raise rents, maybe 6% a year. They do it twice a year, every 6 months, 3%, every 6 months, 3%. It goes undetected. Why? Because again, I forgot my stuff's there. You're hitting my account automatically. I don't even probably know it goes to 103.
Oh, yeah.
And then it was $100, it goes to 103, 106. And, after 3 years now it's back 115, 125. It's starting to get a little irritating. And the reason I haven't moved up till that time is because I know I have to go get a truck, spend my weekend and cost to move to another competing facility to save what, $5, $10 here or there. People aren't going to do it. So that's why self-storage does really well. It does really well in downturns too. It does well in downturns because think about this. If you have a small business, it's maybe cyclical. You don't want all this investment in capital. You just maybe store it somewhere, right?
Right.
So you rent this place for a couple of years until the economy picks back up. Or We're seeing now people who used to have files in a Class A building. Class A building rent is astronomical, right?
Oh yeah.
So people go, listen, I'll start storing that stuff in storage. I don't want to go out there once a month. It's on because these self-storage facilities are now, the modern ones are, they have music playing, they're well heated, they're well lit. You want to be there. You want to hang out there. You know, it's like a coffee shop. They got donuts. You know, the old days, you know, self-storage was off the beaten path in some chain link fence area that was not safe, you know,
Absolutely.
where you didn't feel safe. So, you know, that's the self-storage industry. Manufactured homes we love because they're not building anymore. There's about 50,000 of them nationwide. We have a affordability issue here in the United States. Houses are going up, rents are going up in apartments. There's not many options for people, right? And manufactured home parks are still very affordable for people. They own their own unit. We own the pads. What's the value-add strategy there? We go in and we repave all the roads, repaint the fences, put the landscaping in, take out the old shuffleable courts and put pickle courts is the new thing, you know. We really add value. Now we may take a pad lot that's on average $400 a month. That's what we're charging the people to have their own unit there. And we may take it to up 10% year one and then 5% for the next 5 years or 10 years. Okay. So it's not, if I take your rent from 400 to 440, it's not going to kill you as much as if I, and it's certainly not 5%. It only goes up $20 a year or a month. But if I do it in an apartment and I jacked your rent up 10% and you're already paying $1,000 a month, you may move. So in manufactured home parks, most people will accept that initially because you're adding value, you're doing something to improve their environment, and then you scale it back. But if it's leveraged at 75, if LTV's and leveraged park at 75% leverage, and I raise your rent 25% over, let's say I do it 10, 5, 5, 5 over 4 years, I've probably created twice as much income on the property or value to the property by doing those small moves. And so so everybody pretty much wins if it's done right. Now you hear some abuses out there. That's not the right way to go. We want to work with operators who are adding the right value, caring about the community there, and doing it in a responsible way. And then the investors can profit from that.
Right. And one of the beauties of all these three sectors in general, as you touched upon, David, is that there is no massive developments going on. There are not a lot of assets like apartments, for example. They're not building a whole lot. Like the only way new construction that's being built, and the only way they can justify these projects is do a Class A construction, have rents like 1,700 to 2,000, some ridiculous amounts. And these Class B and Class C, as we call it, are like vintage 1980s, or sometimes some operators I know invest in like 60s buildings and stuff. But these are proven buildings, and we are buying them. And as sound as these investments are, they're really insulated from the market as well. So anyways,
that's a great point. That's a great point. I mean, it's a great point. If you look at, this is interesting. So if I'm a construction builder, can I build Class B, which is kind of where we play? People are starting to look at that, which is basically I'm building an apartment that's lower grade, right? I'm not putting in fancy stuff. I'm doing it pretty cheap. I'm going to have lower rents. But the vast majority of new construction coming on is Class A, shiny stuff, top grade. And what the problem is, they get hit in a recession. Occupancy goes, we saw that in Houston in 2014. Occupancy goes from 95 to 85. So those are high risk investments later in the cycle. And Class B, they're not building anymore. The only reason someone comes to Class B is not many people are building to that scale. Most of the time they say, I want to build A because I make the most profits on A. If I'm going to build something, I want to make profits. And so that's why most of the new construction is not priced for the typical consumer that wants to have an affordable place to live until they can afford a home if they want to someday. Right?
Oh, absolutely. And one of the another interesting facts that I was looking at is the just last quarter, 2018, commercial mortgage bankers report came out. And in that report, it was kind of defining, how much was the delinquency rate across multifamily and all these sectors. And it's really, eye-opening to see that the delinquency rate on these loans are like 0.02, 0.04, 0.7. I mean, whether it's bank loans, it's life insurance, or, some other Fannie Mae, Freddie Mac.
Yeah.
I mean, it really, kind of gives that 10,000-foot view that, okay, let's say, for example, Freddie Mac, Fannie Mae are making billions and billions of dollars of these investments.
Mm-hmm.
And you wonder that, hey, I mean, such loans, like, how are they performing? What's kind of delinquency? Are there any issues? But when you see this, you kind of get to know that, hey, just no delinquency across this sector. So David, thank you for all those kind words. Just wanted to follow up and ask you that, you've seen a lot. I think you've seen so many investors and operators. What do you think separates the successful investors and for people who, maybe like just leave the field or fail in general? Like, what attributes do you think are sort of the hallmarks of success for successful investors?
Well, I think just looking from an investor standpoint, if we can focus on that, what I think is the best thing to do is educate yourself, and you don't have to go, get along a big career or a master's in anything. There's a lot of folks out there that like to educate. We like to educate. I think it's the best part of a relationship. I always tell people I talk to, this isn't a sales and marketing kind of angle. This is all about, this is serious money. We take it very seriously. We want to educate you on the market, the deal, the team, why we think it might be good. And we do that in a way where we all have, newsletters and things and soft approaches. And what I used to do is people like something, they come to us, say, hey, I like that, particular deal. And we slow the process down with them. Really, we just like, okay, let's walk it through. Let's understand that, especially new investors. Like, hey, I met a new investor. They're on my distribution list, and I want to make sure that they're well educated. I put frequently asked questions together on my website. Just do different things to make sure why I like apartments. I started blogging when I started this business. It's been a very effective way to get my thoughts out there and to help people educate. So I think whether you're dealing with me or somebody, Sakar, yourself, or anybody, I think we always want to encourage investments to check their website out, find out what's available. And I think you really want to be working with someone who's really trying to teach you, educate you on the area. We always will have investments to look at, but we always want you to make sure it's the right fit for you, educated to get into these things in the first place. You know how they work, what the time frame is, how you can get your money out. Just get a really good comfort, because we can execute you and get you in the deal fine, and we'll monitor those deals with you. We're investing with you. I mean, we do. Right. There's a lot of questions as an investor I put together from the investor standpoint to say, Dave, I'm kind of new to this. Tell me what I should know, enough to be dangerous. And so we've created a lot of that content for you, so you can. Right. So I just encourage people to read, get comfortable. And before you invest in something, and that way you feel like you made a good judgment, a good decision. So just educating in a space. It's an area also where, if we're talking about operators and who I'm working with, I have a whole special report, the 10 insiders, 10 tips on, how to vet a sponsor. And, those kind of things are important. So you start looking around, hey, I can tell you right now, it's just basic stuff. But the internet exposes a lot of bad apples out there pretty quickly, right? Because we have that medium to get it out quick, and so you'll see the bad apples weeded out pretty quick. But most of these investors, all the operators I work with are very legitimate, very experienced, and very professional. And we want to make sure you're comfortable knowing that not only about the investment, what your experience is going to be during an investment, how we're going to interact with you, communication, responsiveness, customer experience, good old healthy customer experience. Absolutely. A lot of people forget, like, hey, I just raised the capital, I got you in the deal. Okay, great. Let's see how it goes. No, people want updates. They want to know monthly or quarterly. How are we doing? It's not big, extensive stuff, but it's like 4 or 5 bullet points. Are we getting the rent that we expected? How's the occupancy? Let me show you some pictures of the renovation. So you're sitting in Virginia, the deal's in Dallas, you feel like you're part of this partnership. It's a partnership with you. I'm partnering with you. Right. I'm just not selling you on something and away you go. Good luck with that. I'm invested with you. Our goal, and I think a really good syndicate's role, is developing long-term relationships with our investor base. Right. 85% of my investors are return investors or referrals from those investors, right? Absolutely. Right? Because, you're showing them good deals, they're conservatively underwritten, they're having success with that. They want to do more, or they want to tell their friends. And that's the beauty of the business. It's not a business where we're out there pushing hard on this stuff. Right. Provide good quality deals, educate people, and they'll come and and tell their friends, and then you take care of them once you have them. And it's a wonderful business that way.
That's why if you see in my back, it says premium cash flow, learn, grow, serve.
Perfect.
And that's I mean, that's pretty much is what, you know, I was able to come up with that. I mean, in my years of business, I pretty much found that real estate and your personality development are extremely correlated, that, you know, you learn, you serve with integrity, and, you know, whoever people are around you, it's gotta be a win-win relationship. It just, there's just no other way.
And you said the magic word is relationship. We're trying to build long-term relations with investors and educate them in a space that they, what the fun part for me is that most people, you know, if everyone's bought a car, probably most people have bought a house. And so we're not in that area because you already have preconceived notions, biased one way or other about that experience.
Sure.
We're coming at you. Most of the investors, at least the new ones that are coming into our area, those folks have never even thought they could invest in an apartment or a manufactured home park. So what is it all about? So the beauty that I have, the excitement I get is sharing these really cool opportunities. And I have one data point. Well, there's two data points I wanted to leave you with that I think are pretty cool. You mentioned one early on. In 2009, we had the market crash.
Right.
Less than 0.5% of apartment owners were behind on their mortgage.
Right.
4.5% of single-family homeowners. So almost 10 times riskier to own a house or rental property with one income tied to that versus a 200 or 300 unit apartment with lots of incomes tied to that, right? We're not going to get that hit. So this is already a lower risk, okay? The second thing is the reason why I personally am in this space and you're personally in this space, if you look at these three niches, apartments, self-storage, and manufactured home parks, if you go look at the data for 25 years, over 25 years, they outperformed the stock market by 7 to 10%. That's huge, right? With a lot far less volatility along the way, which is like the beauty of it too. You know, there's not this neon light price of my apartment every time I drive by, like a gasoline price. I can always tell. I'm a little bit more nervous when it's going up and feeling really good when it's going down. It's stock prices every day. You're driving in your car. Hey, the Dow Jones was up and the Nasdaq was down, and that's just noise to me, right? But in an apartment, it's a long term. It's more of a longer term, patient investment. But you actually understand how it works, and that it's going to throw cash out, and it's going to help me, and it gets through downturns. So these niches, in the downturns, they perform very well. And I think that's why over 25 years, they outperform. They don't go down 50%. You know, typically don't go down 50% in a given year, right? They may go down, but they're not going down so drastically that you're going to make an emotional decision. And then the other thing I love about illiquidity of it. Yes, it's illiquid, but it does throw out cash flow most of the time, right? Good investment. But it's illiquid, so it would be hard for you to unlock that. You're emotional in the stock market. I go in there and my computer, I sell it. Probably at the worst time, right? It's down 50%. I'm selling, I'm getting out. And then 3 months later, it's up and you're like, oh man, I shouldn't have done that. The beauty of real estate for me, being an investor who's invested in, I've had stock clubs, I've invested in options, is that it's a patient investment and it's a solid investment. And over time, it rewards you and you can't react emotionally to it, typically. Right.
Yeah. And, you know, I appreciate those important points, David. One thing I always appreciate you for is that I think the insight and just the simple candor that you bring and simple common sense you throw into this. I think you've been an executive president and raised, such a big money for your other businesses in your corporate world. You bring in that experience, which I think is very uncommon, that you just bring in those insights that I find are always valuable. I mean, you know, I have heard you on other podcasts as well. And it always, you know, amazes me that, oh my God, I mean, the person can look from A to B to so far down the line. And that's the vision you bring in, is that, you know, just the points that you said right now about multifamily, self-storage, and mobile home parks, like how these investments are insulated, less volatility, and guaranteed returns. I cannot overstate how important it is and how serious it is that all the audience should take note of this and go research the data. I mean, I always say that, hey, listen to us, but do your homework and read about the important stats in this. Anyways, I appreciate your time, David. How can people get hold of you if they have to, learn more about it, how they can get in touch with you?
Yeah, that's great. So we have a website, thompsoninvesting.com. It's kind of a long one, thompsoninvesting.com. But I have a lot of the blog articles and some leadership things that you can read, some podcasts and stuff that you mentioned, Sakar. So I would always encourage you to start there. And then David at thompsoninvesting.com is how you can get a hold of me. So again, David at thompsoninvesting.com. And we have an introduction and just kind of a walkthrough of what's going on with you and understand what you're trying to accomplish, and we'll go from there.
Absolutely. Thank you. I appreciate your time, David.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.